Hello everyone, welcome back to Wealth Wick. In the previous video, we learned what is support and resistance. What are the uses of support and resistance and how to implement them in our trading? How to draw support and resistance zones effectively. In today's video, we'll explore 4 key concepts. Support turning into resistance. Resistance turning into support. What trend lines are, and how to draw them correctly. If you like the way I explain things, don't forget to like and subscribe. So, let's dive into the first topic. Support turning into resistance. In previous video, we discussed how to draw a support zone. Let me quickly recap it for you. To draw a support zone, you need at least 2 points of interest. Using these 2 points as reference, you can mark the zone. Let's take a simple example. In this example, price approached a particular zone and bounced back from it. The next time price returned to the same zone, we observed whether it bounced again. Since it did, these 2 points of interest are valid, and we can use them to draw our support zone. When price approaches this support zone for the 3rd time, if it shows a significant candlestick pattern and bounces back, we can consider entering a trade. As you can see here, price approached the support zone for the 3rd time and bounced back with a strong Marubozu candle. Once this candle closes, we enter the trade, place our stop loss below the support zone, and set our take profit at a 1:2 ratio. However, not every trade hits the profit target. Sometimes, we may even hit the stop loss. In this scenario, that's exactly what happened. Price broke through the support zone, which attracted fresh sellers. Since new sellers entered the market, this support zone now transforms into a resistance zone. When price revisits this zone, the chances of reversal are high. As you can see, price dropped from this resistance zone, confirming its role as a strong barrier. This phenomenon is known as support turning into resistance. Now that we've seen how a support zone can flip into resistance, let's look at the opposite scenario, resistance turning into support. Price initially approached a particular zone and got rejected from it. The next time price returned to the same zone, it faced rejection again. Since both reactions were consistent, we marked this area as a valid resistance zone. When price approached this resistance zone for the 3rd time, we watched closely for a strong candlestick signal. As you can see here, price dropped from the zone with a solid bearish Marubozu candle. Once this candle closed, we entered a short trade, placed our stop loss above the resistance zone, and set our take profit at a 1:2 ratio. But as with any setup, outcomes can vary. In this case, price didn't respect the resistance zone. It broke through with momentum, triggering fresh buying interest. This shift in sentiment flipped the resistance zone into a support zone. When price revisited this area, the probability of a bounce increased. And as you can see, price reacted strongly from this new support zone, confirming its role as a solid base. This market behavior is known as resistance turning into support. Now let's zoom out a bit and talk about a broader concept that helps us track market direction over time. Trend lines. What are trend lines? Trend lines are one of the most basic, yet powerful, tools in technical analysis. They help us visually identify the direction of the market. Let's break it down. When price moves consistently in one direction, either up or down, we call that a trend. A trend line is simply a straight line that connects 2 or more significant price points on a chart and extends into the future to act as a guide. There are 2 types of trend lines. One is uptrend line and another is downtrend line. Let's talk about uptrend line. This is drawn by connecting 2 or more higher lows. It shows that buyers are in control and price is generally moving upward. The line acts as a support, and traders often look for buying opportunities when price pulls back to this line. Next is downtrend line. This is drawn by connecting 2 or more lower highs. It indicates that sellers are dominating and price is trending downward. In this case, the line acts as a resistance, and traders may look for selling opportunities when price rallies up to it. But here's the key. The more times price touches a trend line without breaking it, the stronger that trend line becomes. It's like a wall. The more it holds, the more traders trust it. However, if price breaks through a trend line with strong momentum, it could signal a trend reversal or a trend weakening, and that's when traders start looking for new setups. So in short, trend lines help us to identify the market direction, spot potential entry and exit points, understand when a trend might be changing. They're simple, but incredibly effective, especially when combined with other tools like support, resistance zones, or candlestick patterns. Let's move to the next topic, which is how to draw trend lines correctly. We now understand what trend lines are and how they help us track market direction. But here's the thing, drawing them correctly is just as important as understanding them. Let's go over the key rules. Rule 1. Use clear swing points. Trend lines should connect obvious swing highs or swing lows. Avoid forcing lines through noisy price action. Clarity is key. Rule 2. Minimum 2 touches. To draw a valid trend line, you need at least 2 confirmed touches. The strength of a trend line increases with each touch. More confirmed touches mean higher reliability. Rule 3. Respect the wick, not just the body. When drawing trend lines, a common mistake many traders make is connecting only the candle bodies and ignoring the wicks. But wicks play a vital role in every candlestick formation. They reveal the true rejection zones, where price was pushed back by buyers or sellers. Think of it this way. A wick on a 1-hour candle is actually made up of multiple candles on a 5-minute chart. It's not just noise, it's structure. So don't make the mistake like others and neglect the wick. Always try connecting wick to wick and draw clear trend lines. This gives you a more accurate view of market sentiment and helps avoid false signals. Rule 4. Align with the higher time frame. Always draw your trend lines on higher time frames like the 4-hour or 1-hour chart. What looks like a breakout or breakdown on a lower time frame is often just a wick when viewed from the higher time frame. Lower time frames are filled with noise and false signals. So first, mark your trend lines clearly on the higher time frame. Then drop down to the lower time frame to plan your trades around those levels. Never make the mistake of drawing trend lines only on lower time frames. They rarely hold structure. So to summarize, use clean swing points. Look for multiple touches. Respect candle wicks. Stay consistent with higher time frame. Drawing trend lines correctly helps you avoid false signals and improves your trade accuracy. Thanks so much for watching this video till the end. I've put in a lot of effort to make this content clear, practical, and packed with real trading insights, so you can learn without confusion and trade with confidence. If you found this video helpful, if even one concept made you say, aha, then do me a favor. Hit that like button, subscribe to the channel, and turn on the bell icon so you don't miss the next powerful lesson. Your support means the world, and it keeps me motivated to create more high-quality content just like this. Until next video, trade smart, stay sharp, and happy trading.